All right. Hi, everyone. Welcome to this special TimingResearch.com event. And today I've arranged for a guest that I've known and worked with for over 20 years. And he is an excellent options trader here to share his knowledge with you. But just a reminder, of course, this presentation is for educational purposes only. Trading is not suitable for all people. Please consult a financial advisor and only trade with money you can afford to lose. And this session is being recorded and will be available on TimingResearch.com as soon as I can get it posted. Also, if you search for Timing Research on YouTube, Substack, or your favorite podcast app, you can get all the recordings and events there. So um, I'm happy to welcome Price Headley of BigTrends.com for today's session.
Oh, well, thank you so much, David, and great to be with you all today. It's like David said, we've known each other and worked together for over 20 years, and really a pleasure to be in with the timing research community. One of the most popular vehicles that we're finding and from our big trends traders is the Qs, the QQQ, the Nasdaq 100, because one of the things you get is not just 100 stocks. Everybody knows about the S&P 500, and I'm sure a lot of you know about the Qs too, but you're talking about kind of getting a piece of Apple, a piece of Nvidia, a piece of Microsoft, a piece of, pick your pick your big name tech stock or other growth name, whether it's in the biotech field or some other sectors, but really primarily tech driven. But getting the diversification of not having just all in on one of those names. Palantir's had a great run. Tesla has had its volatility up and down, but this kind of smooths out some of that individual stock by stock to give you that diversified approach and still very active, very liquid. And we're going to talk about the two best indicators that I like to use for QQQ options traders today, with one being a primary and the other being a nice supporting that helps me to determine what kind of option I want to buy. So let's get into it and talk about it here. Just a reminder that everything that I share with you in today's presentation is based on our proprietary research, is intended for illustrative purposes only, and should not be considered specific advisory recommendations here. As you know, stock and options trading have large potential rewards, but of course they also have large potential risk. We're going to talk about how we manage both sides of the coin here, risk and reward. And of course, the past performance of any trading system or method is not necessarily indicative of its future results. Future results will vary. So do see our terms of use on our bigtrends.com homepage for more information here. So our goal with these trades on the Qs, one of the great things about these QQQ options now is that they have expirations every single trading day. And so we're looking for things that can basically pop in 1 to 2 trading days maximum and not buy too much more time than that. So we'll buy 3 days before the options would expire, but only hold them for at most 2 days. Okay. So we'll never hold them on their last day of their expiration. What a lot of traders are talking about zero DTE, meaning the 0 days to expiration. If you're in an option that's going to expire at the end of the day today, I don't think that's giving yourself enough runway. So I like to have a little more runway than that, but not more than I need, because if you buy too much time, you really hurt your ability to get appropriate leverage, to get the kind of bang for your buck that you could get with these several days out before expiration opportunities. And then the great thing about the way we do it is that we like to get in the final half hour or even a touch less before the QQQ options close. And so therefore we give ourselves enough time to get in, but then we won't get out until the earliest the next morning. So you never have a day trade with this approach. We're going to walk you through a bunch of success stories, chart examples when it works, also what you do when it's not working. Okay, so we're going to cover both sides there. And then we call the system QQQ Options Playbook. We do a lot of educating to go with the trade alerts. And so the idea is that you can learn how you can start taking advantage of this, and the earliest trade, our next trade could come out even here before the end of the trading day today. I've been trading stocks and options for over 35 years. I got the trading bug while I was a student at Duke University. Saw kind of the power of, actually, I was in an investment contest for college students where I was doing terrible value buying Coke and Gillette right after the crash of '87, thinking, well, gee, wouldn't that be a good time to buy Coke and Gillette and Procter and Gamble? I think those were three that I definitely had. And then I got my statement with a month ago in a 4 month contest, and I was in the bottom quartile. And I said, "Oh, this isn't working. Time to do something different." I went to an active, quick trading strategy, just basically off of a pattern I had noticed reading the journal even before computers, and went from the bottom quartile to the top 1%. They even sent me a letter saying they hadn't seen such a big comeback. So right away, I kind of got hooked on that more proactive, opportunity, being a little faster or a lot faster to react than I was before. And so, what you have to remind yourself too is that if what you're doing is not working, doesn't mean you have to keep doing it, right? You can always, if it's broke, time to fix it, right? A lot of people say if it ain't broke, don't fix it. I'm always looking to, even when things are working pretty well, I'm always looking at the next edge, the next opportunity. So that's how I would say my philosophy is always be green and growing, not ripe and rotting, right? That's a Lee Iacocca quote, former chair of Chrysler. But the idea is, yeah, we want to stay fresh. So we always focus on a systematic approach that gives you a quantitative edge. But remember, we're still trading probabilities. Probabilities mean sometimes you're going to be right, sometimes you're going to be wrong. Even if you're got a high win rate, you still got to manage the other times that it's not working. And let's actually kick off today's event with a winning trade example we just booked yesterday. So we like freshness. My team's so good at updating the charts. And as you know, we've been in a strong market here, right? Here in the last couple of months after the sell-off from the Liberation Day tariff announcement that our president made those initial kind of startling tariff proposals, and then of course he backed off on them. And the market's been recovering from that. And what you see, the indicator on this bottom panel here is the indicator that Larry Williams developed, and it's called the percent R, which means percent range. Percent R, okay? We draw it in as a scale from 0 to 100%. So if you were defining like where the market has been, this is the QQQ vehicle, right? These are daily candles. So as you know, the red candles mean we close below where we open. The white open bodies mean we close above where we open. And of course, yesterday we had a big gap up. We were in the day before that, the afternoon before. So, but what we want to focus on here is that if I was defining the range, even if we were just looking back over the last couple of weeks on this chart, you can see that the low of the last couple of weeks is actually the morning, yesterday morning before we got in, and 2 days ago I said Monday morning before we got in, and Monday afternoon. So the low is about you can see here about 524. If you look at the recent high, it shows up here about call it 536. Just for a round number, it might be able to touch above that. So if I was telling you what's the range, 524 to 536, well, it's a 12-point range. So just right away off of that, you would say, well, where are we closing within that range? So if we're closing up around 536, then basically we're going to be at the top of that range. That would be the 100th percentile. If we're closing down at the low of that range, that would be around 0%. Now you can see percent R recently in the last few weeks really has been stuck in the top uh, portion of its range, right? The top 20 or 30% of its readings. And what we like to see is that you can see here when back on Monday's close, when it came back up and finished up here just over that 80th percentile, right near the end of the day, we're saying that's actually a continuation signal that we want to be long the Qs going into the next day because it tells us that we're not breaking down, we're not coming out of that overbought area. And thus, you can see that because we've had a prior rally phase here, that this little pause that we had over the prior couple of week and a half, really, right? So that trading range, it looks like. The percent R ends up being kind of a trend following tool to me when we're staying strong and continuing to stay strong. So we said, look, we like how it was coming up there and flipping back into the top 20% of readings, closing on the high end of the range. And so this is like my driving indicator. We actually have an oversold setup as well when things get kind of flushed out on the downside. And we've got a bearish setup as well. If we're in a downtrend, then we get a bounce. So we'll talk about each of those setups. So this is one of the three main setups here. So we're getting in there near the end of that day, back on Monday when the Qs had closed around 532. So what do we buy on that afternoon in the last 30 minutes of the trading day? And this is another little important distinction here. The QQQ options can actually trade until 4:15 Wall Street time. Everybody's used to the 4 o'clock close, to hear the bell ring, the gavel pound down. Well, that's true for the cash markets, but for the QQQ options, they keep trading until 4:15. So we could get this signal out via real-time update at around 3:45 p.m., even a hair later. Still feel like you got enough time to get in. We can send you mobile phone updates as well via the WhatsApp technology when you become a subscriber, and we'll tell you more about how you can get a great kickoff try it out for a little while offer here at the end of the presentation. But the key is that we're saying, look, this is a continuation pattern. We're bouncing off of that support. In the morning, maybe people thought, oh, of course, we had all that fear over the weekend about, the U.S. striking Iran with the three targeted nuclear sites. And yet, after that initial little attempted flush down in the morning, which is why we do not recommend putting a stop right off the prior day's low, right? Because if you did that, you get stopped out the worst right off the morning lows there. You'd be out and then it miss the entire flip back up, right? So we're waiting for the end of the day, not getting faked out by the earlier in the day action, looking for the end of the day setup, and then looking to get into a 3-day option here. So it was June 23rd. So we bought, that was on a Monday close. We're buying out to the Thursday end of day expiration, June 26th. 3 DTE, 3 days till expiration, Tuesday, Wednesday, Thursday, with no holidays, obviously, this week. But the idea is that, okay, so we're buying 3 days out. Do we think we're going to need 3 days? No, we would not hold it past the end of day, the day before June 25th on what is now today, right? So we held it yesterday, and then you see what happened. We paid, by the way, at the end of the day, Monday, we paid $4.30. If you're new to options, type in for me how many of you traded options and do it this way. Type a number. If you've never traded an option, type the number 0. If you're in your first year of your options experience, type a 1. If you're a 20-year veteran, type the number 20. And just give me a little flavor for if I'm talking to new option traders or long-time traders or some mix, right? The idea is that when you think about this, if I buy a 530 call, I'm going to assume that mostly we've got some new traders. I got a 10-year veteran with Bruce. Thank you, Bruce. Great to see you. And you look at this and say, okay, we're at 532, and I'm saying I'm buying a 530 call. Well, that's a right to own the Qs at 530, and it's already at 532. So that's 2 points in the money. So when we pay 430, that's $430 to control 100 shares of the QQQ, which is worth a little over 53 grand. We're controlling that 53 grand that we would have invested if we bought the Qs themselves for basically, as you can see, about just under 1/100th the value of that, just $430. But two of those $430 are intrinsic value. And so the idea here is that from that, we know that we're only paying about another $2.30 or $230 of our $430, slightly more than half, is time risk. Okay, so that time risk is a factor. We're only buying them. We're not selling them. A lot of people might want to sell options as they get close to the expirations. We're saying no. The opportunity here is meaningful enough to say we want to take advantage of a straight purchase of a call or in one setup a put, which we'll show you later. But in this case, look, yesterday's rally, look what the Qs did yesterday. As we continued to surge higher, you can see big breakout, right? We went from 532 and we almost got back to the old highs right around 540. Now today we're through it, obviously. Today the Qs have rallied still further. And so, we pushed on the old highs are right around 540. We pushed up to 542. We're now back to about 540 and a half, give or take. So kind of testing that 540 longer term, could we break out there? But the point is that we are happy anytime we get a double in a day or two. Okay, so if you were investing, say, $1,000 a trade, this would allow you to buy two contracts for $430 each, or $860 total investment. You couldn't get that third contract that push you up to almost $1,300, right? Anything over 1,000, we wouldn't buy in any other contracts. So $860 invested, it goes from 430 to 860. So our $860 investment is turned into $1,720. You got an $860 profit before commissions. And of course, commissions have come down dramatically. No ticket charge anymore. Maximum you should be paying is $1 aside on two contracts in, two contracts out. That'd be $4 round trip. So you can see here you're taking down an $860 profit minus up to $4 for commission. So 860 gross for basically less than 24 hours work from Monday afternoon to midday Tuesday. So the point of this is that, okay, we want to find these setups and be able to rinse and repeat and then get back to the sidelines. And I don't know about you, but in this market, I really don't want to hold anything that long. You say, oh, the market's great, it's bouncing back, but it's very news driven. You know that the tariff pause basically is due to expire like the second week of July or you know was it the 9th or the 12th, sometime there before the middle of July. And so the question will become how does that get handled from there? Do we keep delaying it, or do we start to see the impact of tariffs start to sink in if they actually get implemented? Who knows? But point being, we're not going to play that what if game. We're going to say, no, we're going to keep trading through it, but we're going to tighten our time frame. I think it's a great way to keep you engaged, keep you looking for opportunities, and also managing risk. Because for every time we're targeting a double, we're putting a stop in case it drops 50% against us. And I know those sound like big numbers, but you have to remember you're trading a relatively smaller amount of capital compared to owning the Qs themselves, right? So if we invest $430 and we lose half of it down to 215, maybe it goes down to $2 even if we have some slippage, you're still out no less than 250 bucks. So, that's something where you're like, okay, can you handle making a double versus losing 50%? That's the kind of 2-to-1 reward for our risk that I want to stack in our subscribers' favor. So, quick few strategy guidelines here. You can see we're not going to hold it more than 2 trading days. We will never have a day trade. So, when we're in late one day, the earliest we could be out the next morning. So, no day trades. There's actually 3 different percent R setups analyzed on a daily chart. And I'm going to talk about our second indicator as how we use the second indicator, which is the average true range, to help determine which options we should trade. That's helped us a lot, especially with the volatility of the post-tariff world announcement that we're living in. So, but these are just simple straight call or straight put purchases with no spreads, no options selling other than shutting down the position that we bought. Previously, we always use 3 DTE, 3 days until expiration. We're also only focusing on the daily chart. We don't want to use intraday charts. Why? Because intraday charts, the more short term you go in your intraday charts, the more noise you're bringing into your picture and into your analysis. Noise, I don't know about you, but noise has never been my friend as a trend trader. I want to ride the true trend. I want to avoid or minimize the noise, the fake out, not getting shaken out, having staying power, and not getting whipsawed by some random little bit of intraday movement. Okay. I believe the markets are kind of designed to shake out and fake out the majority of traders, right? And so you've got to have ways that you can manage that. So we smooth it out. We like to get into these signals at the end of a trading day when we have one of our validated setups confirmed by around 3:40, 3:45 p.m. Eastern time. You say, well, that's only 15 minutes or 20 minutes before the cash market closes. But remember, the QQ options will trade until 4:15. So it gives you at least a half an hour to work with to make sure you can get in. And that's why we do recommend you get set up when you get signed up for not just your email, but also for the follow-up we'll give you on how to set up mobile phone texting to your smartphone via the WhatsApp technology as well. This allows you to know that you're not going to be screen watching, wondering if we're making a trade, and knowing that we have reps standing by all the time. If you've got a question during any trading hours, you can reach out to us at our 800 Big Trends line, and we give you a dedicated email access to me and my analyst team too, if you ever got a question about a trade or has a trade come out or whatnot. So eliminates noise, eliminates the screen watching. Basically, it's about maximizing your bang for your buck, not just on your investment, but on the time that you have to put in, which is relatively minimal here, looking at it at the end of each day. So that leads to plenty of trade opportunities, plenty of profit potential, and not a lot of noise. Okay. So the nice thing is we get a lot of leverage for a relatively small investment because we're not buying the monthly options or even next Friday's expiration. We're buying just 3 days till expiration. Our average contract price going back to the beginning of 2023 has been $3.31, which would imply that putting $1,000 in, that would get you an average 3 contracts in for just a hair under your $1,000 cap on average, knowing that sometimes we might get 2, sometimes we might get 4, that type of a thing. Now, trades, sometimes we might get 1, but the point is that whatever's the right one to trade, that's the one we want to trade. We will get out after 2 trading days later at 3:40 p.m. Eastern if we've not already hit our profit target or our price stop. This will make sure we're not hanging around and hoping for the final day of movement because that last day, of course, the melting ice cube of time is melting really fast. And so we want to not play that game. We'd rather play the game before we hit into the expiration day. Now you say, okay, well, that's just one example. how have you done over the longer haul? If you look at our overall performance, adding up all of our winners and losers before commissions, before subscription investment, you can see that if you took a $25,000 portfolio, you say, okay, I'm going to put in, say, 20% of that to start, 5,000 a trade, but I'm going to keep it fixed at 5,000 a trade going forward. That we like that fixed dollar commitment. It will tend to smooth out your experience compared to those who are trying to crank up their amount invested per trade. We're not doing that here. $25,000 portfolio grew to over 105, I'm sorry, 115,000, and thus made over $90,000 in gross profit before subscription investment and before commissions. Now, of course, you can start with less. You could trade $1,000. You could trade a variety of different sizes. We'll look at 1,000 next, but just want to remind you that past performance never guarantees future results. Future results will vary, right? This is the beginning of 23 through today on all closed out trades. But the point is that there's the next 2.5 years could be up more or up less or down. There's always risk of any of those things, right? But we're going to manage intelligently, following our system, not getting too high or too low. You see, now if you took the smaller amount to commit per trade, say you start with a $5,000 model portfolio and just put in $1,000 maximum per trade, then you can see that would have grown to over $16,400 in gross profit. And of course, that's using the same fixed $1,000 a trade without any compounding, any growth in that commitment. Just saying we'll go up to but never past that maximum commitment of $1,000. So in that sense, you're saying, okay, well, look, a $5,000 portfolio grew to over $21,000 for $16,000, $414 gross profit before commissions and before subscription investment. So when you look at all that, you say, okay, past performance can't guarantee future results. Future results will vary. The idea is you can trade it small, you can trade it medium, you can trade it large. There's something there for everybody. Now, our specific setup is tied to percent R, and I'm going to talk more about the average true range as our second indicator in just a little bit. But percent R is really all about, okay, is percent R giving us what we want? And then we combine it with the how are the candles showing us? Are we closing higher than we opened? Are we closing lower than we opened? These setups can be very valuable to tell us, okay, there's potentially like 8 different combinations. We'll only trade 3 of those combinations. And yet still we'll get plenty of trades, expecting an average of about 8 trades a month, give or take, a couple trades a week on average. So we'll use Larry Williams percent range indicator to show us these windows where we have a new setup, the candle's confirming, and then we'll look at history. We're looking at what we call the historical profit factor to determine which of these trades are best using a bullish trade or a long trade, a bearish trade or a short trade, or don't trade at all. So let's look at more trade examples that are worth a lot more than my words. Now, this one here is one where you can see that we had been oversold. See, percent R was hanging down here in the bottom 20% of readings. You say, how can you have it both ways? Well, there's just certain patterns that we're looking for here. So at that point, we're saying, yes, okay, we know that we have a good setup here. We know that this is more of an oversold bounce setup coming here. We're buying into the 476 calls out several days into the March 21st expiration and paying 487. So if you're investing $1,000, that'll get you 2 contracts in for just under $1,000. And so that one you can see the very next day starts to gap up. So the open is higher, but then you see it keeps on going throughout the day and gets as high here as 485, give or take. So of course, 485, the 476 call is worth at least $9 intrinsically, and you've got, because of that quick move up, you've got a pretty nice um, opportunity to say there's some time premium there. Let's just go ahead and take the profit. And you can see here we're taking down the 100% gain. 487 turned into 974 times 2 contracts, right? So you're taking down just under $1,000 before commissions on this trade. But again, 2 contracts in, 2 contracts out shouldn't cost you more than $4 round trip. So it's a beautiful thing here when you see this kind of pattern. You see, as it turned out, we were basically just testing those old highs from a couple of trading days before. Remember, on all these examples, past performance never guarantees future results. Future results will vary, but it's based on allocating up to and no more than $1,000 per trade. We were locking it down, taking the $974 and saying, excellent, glad to do it. And that's really our objective right now is looking for that next good low risk entry point, never forcing a trade, and then making sure that we can take advantage of it. So that's a perfect example of like, okay, an oversold situation that we thought had a bounce potential here. And now here's another one that's more one of those bullish setups, like what I was just talking about on the trade from Monday into yesterday morning. This is where the Qs have been strong. And then you see they're taking a little pause here, but you see we're not trying to buy the first dip. That would have worked in this case, but we're trying to say, no, let's get the nice, kind of flip back. You can see opening lower, maybe flushing some of those stops, and then flipping back a bunch higher. And a lot of times that's going to give me, even more um, confidence in our setup and our pattern when I've seen these happen again and again and again. And so I know exactly how we're going to trade it, win, lose, or draw, right? In this case, we put in for the 530 strike calls. We're trading just a hair under that, maybe 528 and a half, and we're only paying 299 bucks per each 100 shares, and so, for each contract controlling 100 shares, I should say. And so 100 shares, of course, would cost you just under 53 grand. You're controlling that for just about 300 bucks, right? Tremendous leverage potential. And so 299, we just needed to double to 598, right? So that means that's only like a 3 point move in the option, but of course you need more than a 3 point move in the Qs, right? Because if it's slightly out of the money, the delta on that thing might be a little under 50%. So I might think we need probably a 6 point move to get about three of that in our option. You can see from 528 the next day, it does trade just over 534, maybe 534 and a half. Some 6.5 points higher. We're able to ring the register, take down the quick 3 point move in our favor, and take down almost a $900 profit, $897 in gross profit before the $6 maximum round trip commission. So it's a beautiful thing when you can find these setups and then we call them out first. We find them for you and then call them out for you. Now, there's trades that might not hit their profit target and might not hit their price stop. We call them time stops. And the time stop rule says, hey, we're in right here, June 2nd. We got into the June 5th, 520 strike calls. We were trading in the money. This is why do we trade this one in the money when everything else I've been showing you is near the money or slightly out of the money? Because this is where the second indicator comes in. It's called the average true range. We're trading about 527. Now maybe we weren't there half an hour before. It might have been a little bit under, maybe just below 526. Buying a pretty deep in the money 520 strike call out and paying just the 578 there. But the point of this is that we will call out these trades and we're going more in the money because the average true range, our second indicator, average true range, said we have a lot of volatility priced into the options here because of the shakedown to the downside and then the corresponding snap back up through a lot of May and now in retrospect, a lot of June, right? And so with all that volatility priced in, even though volatility levels as measured by the CBOE volatility index or VIX have dramatically dropped, those are down now to about 17.2 when they were at 60 right after the Trump Liberation Day announcement early April. So what I'm looking at here is saying, okay, we think there's potential, but we did have to buy a more expensive option. We have to buy a more expensive option, 578. It's going to be harder to turn that into an almost $12 option. You see, we do get a rally. Unfortunately, we don't get to 12, and we cash it in 2 days later, the final half hour of the trading day at about 3:45 p.m. 9:29 is our average exit. That makes us about 60% on that trade just 2 days later. Remember, they were going to expire the next afternoon, so we're not going to hold them into that final expiration day. We're going to reduce the gap risk. And that trade, since we could only get one contract, it generated $351 in profit on a higher dollar name using the 48-hour time stop rule. So again, that's an example where it's not quite as big of a potential profit, but it is still actively managed. And we're going to expect to see plenty of these opportunities. When you think about it, there's about 21 trading days on average in a typical trading month. We're expecting to generate about 8 new option trades a month, an average of about 2 a week, but about 8 a month is our expectation. Sometimes it could be a little more, sometimes a little less. Now, I mentioned the bull setups. Here's the bear setup. This is going back to a prior downtrend. Back here, you can see in October, market dropping. You can see we've got percent R staying pretty much in the bottom 20% of its readings here, right? What does that mean? It means we're not finding support at the bottom of any recent low. We're continuing to make new lows, right? So guess what that does? It basically stretches out the range, you know. And the range is expanding to the downside. That's a bearish thing while that's happening. You can see what we look for is that we get a big snap to the upside, and you can see we get this one little pop back up above that kind of short-term oversold zone around that 20th percentile. We pop back above that. And by the end of the day, our bet is that we can stay at or below that. And so that you want to take advantage of that and bet that's going to snap back down. You can see what happened. We got in there to the basically at the money 268 strike put. We paid about $3.50, $353 officially to control each 100 shares. We're thinking it's going to snap back down. The next morning, it actually initially snaps up. So this is where you want to have a wide enough berth that you're not going to just stop it out if it trades above yesterday's high. A lot of people would do that on the gap up and they'd say, oh, it looks like it's going to keep running. And then they blow it out and then it flips on them while they're left on the sidelines, right? We don't want that for you. So we did not get our stop hit and then it starts reversing back down. It goes from, you can see in this example, opening up about 271 and finishing down to a low near 260, right? So that's a pretty big range, about an 11-point range on that day. If there had been a gap, the nice thing about the average true range indicator when we're going and looking back over typically about the last month is gaps will also be included here. When you see that kind of gappiness in the chart, the average true range will encompass the amount of any gap up or down. So, when you understand that, you say, okay, well, then this is probably a one-day wonder rally, and you get ready to make sure that you're not going to try to chase too much of your assets into any one trade. We want you to stay very consistent, very stable in your capital allocation. That's what I would attribute a lot of the secret of my 35 years in the options trading game as not getting too high or too low, not expecting any one trade to make or break me, not having to sweat that, right? Just I'd rather see you start small, even if you're just trading one contract at a time as a new subscriber, just to get your feet wet in how it works and how you can benefit from it, what the risk looks like as well. This is a fascinating little example because this is both before and after the election back in early November. So we had both of our bull setups triggered. The first setup, of course, the market had that little pullback. So we're coming out of this little oversold condition here into the end of the day, having a red candle here. We're trading about 486. Of course, the election's about to happen the next trading evening after the next trading day, right? And you can see here that we had the quick in to the 491 calls. They're about 5 points out of the money, and then bam, we go from out of the money to slightly in the money. It trades up to about 493, and so in this case, with that kind of speed of movement, elites. In this case, you're getting a $4 and one, at least about a $4 entry here, 401 really officially. And then you're saying, okay, we're getting out when we double that at 802. We got a little better than that the next day on the pop up. We got 805, 100.75%. It's basically a double on those 491 calls. That's before the election. Now, we didn't take a trade into the election. We're kind of see by the end of the day, we're starting to come back up, but not quite where we wanted it here on that percent R setup. So we said, let's wait, let's see what happens. We gap up huge, right? We had the Trump wins, we had the gap up, Wall Street pouring on the gas here. By the end of the next day, it's rallied all the way up to 505, 506. A lot of people say, oh man, I can't believe I missed it. It's rallied. And yet what we're looking at is that that's now a bull setup. Right now we're up here about the 98th percentile, right? We're closing just off the highs, which is measuring that day's high as your top of the range. Closing just off the highs. It's not 100%, but it's getting up there. And that's now checking the boxes for a super strong close, super strong percent R. That's a sign of an uptrend developing and continuing. We buy the 505 calls, pay 409 for it, and then we double them to 820 out at 100.5% gained the next day. See the 505 calls, we went up to 514, got up to about 9 1/3 intrinsically. We were out before that at 820. So this is exactly what we're looking for here. This is the both had both set us both before and after the election in early November. Now let's face it, not every trade will be a winner. We're going to have losing trades. How do we handle losers? Well, remember, there's two ways that you could get a trade closed out and it could lose. One is if it's your price stop, which is a 50% loss. That's what this happened here. If in 2 days we haven't hit our price target or our stop loss, you could have a smaller loss on a trade that just wasn't moving on our 2 day time stop rule, 2 trading days later, but getting out before the final day's expiration. So this example, we were back into that, top 20% of readings on the percent R, the blue line here. We're back up. You can see not quite at the highs, but getting close. And the idea is that, okay, it looks like it's starting to stabilize. A dip should hang in there okay. And you see it just keeps dipping all day. We had um, in this case, the 508 calls they were recommending when we were about 509, about a buck in the money. We paid 333, right? So you can get three contracts on $1,000 for 999, and then you get your stop hit when it goes down just below our stop level, ends up at 53% loss by the time we get filled as it pops on back down from, you can see that day's close is 509. The next day we traded to 502, right? That's like 1.5% against us. That's going to happen sometimes. But the point of it is that that's why you use stops. That's why you seek to limit the damage when it's not working, but also in this case, our target is twice the size of our loss. So we think that that's really valuable. Also, you can get trades that can gap past your target. And this is one that was a winner, even bigger than we expected. Here's a case back in late September where we were again just staying incredibly strong, right? The market just hardly budging from that upwards momentum. And our system here said, yes, you should be on this. And from that perspective, we're getting in there when the Qs are trading around 485. We're buying the 485 calls about a buck in the money, paying just under four. So still have a lot of time value here, right? But you can see why that makes sense. The um, next trading day after we got in there at 391, it's ripping up, gapping open up here to like 493 and a half. Um, and you can see at that point we're worth something like what? 9.5 intrinsically. We're out at 955 right off of the open. And we take 144% gains. Sometimes you get a windfall better than your 100% target. Sometimes it gets stopped below your 50% loss too. You got to be able to say, I can handle any scenario that the market throws at me because I'm not going in super leveraged. I'm not going in, with a bunch of margin money. I'm saying, no, I'm just basically using options to create my leverage. Even in a cash account, this can be very advantageous. A lot of people say trading 3 days expiration that close would be seen as aggressive. Obviously, not as aggressive as 0 days expiration, but more aggressive than, say, the monthly options buyer. And I understand that, but the beauty is that we're helping you with this very unique trade management approach. It's been very effective. And then again, a reminder on how it's performed over time. I see some came in late, and so we walk you through here. So great to see you, Michael B., longtime big trender, and more popping in here. Richard F., great to see you as well. Bottom line is that you can see this is the history going back to the beginning of 2023 through today, through actually yesterday's close, which remember we showed you we got out yesterday on that latest winner for our double target. So the point being that okay, we're taking $25,000 portfolio, we're growing up to 115,000 for a 361% gross uh, return. That's gross before commissions and before subscription investment. That's 5,000 bucks a trade fixed. So it doesn't try to compound the amount invested per trade. It's a more conservative way to show it. If you only wanted to do 1,000 bucks a trade, you can see it grew a $5,000 portfolio to over 21,000 and change for 328% gain on that $5,000 model portfolio, growing very nicely. So a big part of all this is that yeah, timing is important, but the key is that we're looking for these types of setup. It's something where you can get real-time trade alerts, and like I said, it could come as early as this afternoon. So the way this works is that usually we sell a year or more, because we have a lot of subscribers in the service and we have only a limited number of spots. But I just approved something that David's been good to me. I just approved something that I can share with the timing research crowd today. Say, look, you can get 3 months. I don't really believe in trying it out for just a month. I think you need to try it out a little bit longer. and I want to give you enough value to make it worth your while to do so. So what we're going to do is we're going to say, okay, you're going to get all the same benefits that a longer term subscriber would get in terms of the settings and rule sheet. You'll get access to that. Part of our terms of service says, okay, you just promise not to share that with on the web. It's for your own information, so you can follow along for all of you home gamers out there. You also get weekly video training from me talking about the markets and talking about our QQQ trades and what worked, what didn't work, and why. Also access to my analyst team via dedicated email address, and myself, I'm also on that list. That makes it a $891 value for the 297 a month times 3 months. But what we've done for you is we've set up this QR code here on the right, which you should be able to scan with your phone, or you can go to this link at the bottom of the page and say, look, 3 months would normally cost you 891 bucks. Scratch that out. We're going to take 700 bucks plus off, take it from 891 to make it your price today only 177 bucks. If you think about it, for the next 90 days, the next 3 months or 90 days, that's basically getting you down to less than $2 a day as your effective research cost to have us be your unbiased system executor telling you when to get into which option, when to get out of each option. You're never left hanging. We got a customer service team standing by. And the key is that you are definitely in that spot where you say, okay, look, for the potential on one trade, we've shown you a bunch of trades that doubled or more. The potential on one trade could give you many-fold ROI on your investment, right? If we're talking about trades that put in 1,000 and could double and make you 1,000, you're paying less than 200 bucks. You're paying just 177 bucks for about 2 trades a week, about 8 trades a month. So over the course of the next 3 months, we're expecting we can get you somewhere around 25 trades, give or take, or more. And the key being be patient when it's time to fire. We'll start firing them out much more quickly. And more importantly, if it's not time to fire, know that we'll do the right thing to protect your capital, protect your confidence, only take the best of the best setups here. So you get TimingResearch.com/BT. Thank you, David, for posting that. That's your link here to go there. And we've got an extra bonus for you today as well, that David just put in as something that he's offering too, which is the Stock Watch List weekly newsletter. This is a whole free year of that weekly Stock Watch List newsletter. So the next 52 weeks on that one, powered by a comprehensive algorithm, scans through thousands of stocks every week, looking for key known statistical factors based on history, and then they've been linked to recurring stock price increases. I like the sound of that. With up, you want to be on the leaders. You don't want to be on the laggards. You don't want to try to buy dogs. You want to buy leaders that are working. And so that newsletter delivers a tight, focused weekly watch list of 3 high potential stocks every Sunday at 1 p.m. Eastern. Nearly 3 years of history there for it on Substack. These are algorithm or algo picks. They're all NYSE or NASDAQ listed. They're optionable and they're highly liquid, priced over $3 um, per share on those stocks. It's ideal for both active traders and longer term investors looking to be more proactive in beating the indexes, getting into the leaders. This is definitely the nature of this market, folks, is that it's something where you see a lot of rotation. You see a lot of jumping in, jumping out of key sectors. And so there's also an additional bonus report when you get signed up for that and get that bonus today. You'll get an additional bonus report, 16 beaten down stocks set to soar. Now, when people ask me questions about my QQQ options playbook and say, hey, if I'm going to get this for the next 90 days, I need to understand the system better. Well, what's the strategy? Simple buying of a call or a put based on our percent R setups. And then we use the ATR, the average true range, over typically the past month or so to define what's the right option premium. A good little guide on that second indicator, folks, is we'd like to say that we'd like to buy an option that's about half of the ATR over the past month or so. Okay. So basically, if you've got a $6 ATR range on the Qs, we'd probably be buying something akin to about a $3 option. And we go in and look at the 3 days out. Where's the $3 option, give or take? So kind of adjusting it to recent volatility. When the market was a lot more volatile back in April, it definitely made us go and pay more for those options to kind of equally adjust it out there. But when you look at when we get these trades out around 3:40 p.m., 3:45 p.m. Eastern, right before the close. real-time via email, and you can get them as a text alert via WhatsApp to your smartphone. We'll close them out up to 2 days later if we haven't gotten our price target or our stop loss that we would say take them out 2 days later, 2 trading days later around that same 3:40, 3:45 p.m. Eastern exit time. We'll average about 8 trades a month. In a year, that's about almost 100 trades, 96 trades in 12 months based on that. Of course, the next 3 months, we'd hope to do at least uh, 25 trades. So, like I said, that's exceptional value on the special 3 month trial offer. Will there be any day trades? No, not a single day trade. We're in so late one day that we'd be out at earliest the next morning. And then as we go through and say, okay, recommended price 331. That means you can average about 3 contracts per trade on $1,000 committed. If you want to commit less and start small and just kind of ease in and get comfortable with it, that's fine too. But we tend to recommend being consistent on your capital allocation over time. So you also get the weekly video training from me. You get my settings and rule sheet for the QQQ options playbook strategy, and you get a dedicated separate email address to me and my team of analysts here. And so when you go to that link, I'm going to go to that link here in just a minute, but just a reminder of what one trade was able to accomplish, the one that we just cashed out of yesterday. Remember, we got in to the 5:30 calls expiring 3 days later, would now be expiring tomorrow. We would, if we weren't already out at our double, we would be getting out today on that one, but we're already out because it gapped up yesterday. So we're able to book that 100% winner in less than 24 hours. This trade generated a total of $860 in profits. And you can see going back to the whole strategy here, we're able to take a $25,000 portfolio up to, as you can see here, over 115,000. And you can see also that, again, allocating the same fixed 5,000 a trade, never overcommitting capital. Just being consistent on your trade entry execution rules, that will tend to guide you very, very effectively here. Okay. So like I said, 3 months of the service would be 891, 297 bucks a month times 3 months. But slash that today, we're taking it down below the usual 1 month list price. You're getting it today, slash the 891. You're getting it for, you can see here, more than 80% off, less than $2 a day over the next 90 days, just 177 bucks. Like I said, one trade alone has the potential to greatly improve your ROI on this phenomenal 3 month value, just 177, with all the support, with all the resources, with all the education. So you go to that link there, David set it up there. It's TimingResearch.com/BT. And that's what'll get you that order page. And you'll see on the order page here, it's really simple, right? I just popped it in on a separate page. You see, if you got any questions, call our 800 Big Trends number. Remember, it's 800-244-8736. You can also email my customer service reps directly via clientcare@bigtrends.com. So you can see we've already taken all discounts here. It's already waiting for you. So all you have to do is click on the terms and conditions, review that, make sure you're good to go. Hit, in this case, um, this either complete my purchase button. If you're putting your credit card in on that page, that's the TimingResearch.com/BT page. It reroutes you to our order page here, and you can see that you can get your credit card information in here. Make sure if you're doing it in manually, get that email in right. That's critical. Get that email right, and then you can see what we have there. You can complete your purchase, or you can review the terms and conditions either way, and then go to PayPal as well, and that will also walk you through how to make that work for yourself. So remember, that's all available for you there at that special link we set up for you. It's timingresearch.com/BT. That is US dollars. Daniel T asked about that. So thank you, David, for answering that. What's the price after the 3 month trial, says Raleigh or Rolly? Well, basically, I think you'll be willing to pay a more normal price when you see how much you can get bang for your buck wise out of even just one good winning trade. But I want you to experience, how it works when it's working, how it works when it's stopping out, how it works for you over the 90 days. And then come on back, and I'll definitely be happy to make it worth your while to do so, to extend your subscription out past the 3 months once you let us know that your 3 months is coming due soon. So it's a phenomenal value there, and made even better by David's additional value that he threw in here with that stock watch list weekly newsletter. The free year of that includes all kinds of interesting uh, key names uh, that are being potentially traded here. This is an algorithm-based system trading NYSE and NASDAQ names priced over $3, right? So we're not dealing with the penny stocks. We're looking for names that are generating a lot of institutional interest. And so that's what we have for you here. You can see it includes the extra bonus report, 16 beaten down stocks set to soar. Like I said, now it's your turn to take action. So definitely go there right now. It's TimingResearch.com/BT for big trends. So I appreciate David having me today. It's been a pleasure to share with you what's become one of our most popular strategies among a whole bevy of different strategies we have at Big Trends, because you get the instant diversification of the NASDAQ 100 QQQ. You get one of the most liquid active trading vehicles out there in QQQ options. You get, and remember, those options trade until 4:15 p.m. each day, not 4 o'clock. So you get that late afternoon signal whenever we've got a new trade. I encourage you to sign up so you don't miss our very next trade, which could come out as early as this afternoon, right before the close. Like I said, 297 a month times three, it's an $891 value. Yours today for only 177 bucks. That's more than $700 off the usual retail price of 891 for 3 months access. So you're saving a ton here when you act quickly. So don't sleep on it. Go there now. You'll get the training resources. You'll get the access to me and my analyst team, as well as all my other dedicated crew. So anytime you got a question, know that we're standing by to help answer anything that's on your mind related to options trading, the markets, etc. So go there right now, timingresearch.com/BT to get your ticket for what I believe is a phenomenal value way to test drive this over the next 90 days. That way, you're not having to overcommit capital. You're not having to expect it to pay off right away. If you buy a multi-thousand-dollar product, you have high expectations there too. But a lot of times I find that people tend to be like overcommitting their capital. Don't make that mistake. Be in the game for the long haul. This system is kind of a rinse and repeat, looking for numerous opportunities where the queues continue to, in this case, trade very well because they're led by market leaders like Nvidia, like Apple, like Microsoft, and a whole bunch more. So you're really getting great exposure to it. Try it for the 90 days. It's only 177 bucks. Like I said, one trade on $1,000 invested that doubles could pay for this like 5 times over, right? So just know that the opportunities are out there. It's just your job now to say, are you willing to commit and spend some time to really set yourself up for, the best of the best type of an opportunity where you not only see the opportunity at hand, but know that we'll always follow up with you. We'll never leave you hanging. I see a lot of other services that basically they'll fire a bunch of stuff out and they'll only talk about the ones that worked. We'll talk about every trade we fired out, win, lose, or draw, when it's time to get in, when it's time to get out, or if it's somewhere waiting for the next good setup. So Daniel asked about CoreWeave, CRWV. That's a wild one as well, right? But we're trading this more diversified QQQ vehicle because we want to be getting a piece of Apple, a piece of Nvidia, a piece of a lot of these key growth names, whether it's Microsoft, whether it's Tesla, and you can have all your opinions you want about any of those individual names, but realize the market's going to do what the market's going to do. Your job is to catch it when these patterns set up nicely and cleanly. And I think you'll find that this is one that will become a regular part of your trading arsenal. So thanks again for having me, David. It's really a pleasure to be with you all today. Go there right now and go to timingresearch.com/BT. That's your ticket to lock down this exceptional 3 month offer, only 177 bucks. So definitely appreciate the kind words, Michael B, on the summer scorcher price point. Yes, we've made it super attractive, a blazing hot special there. So Appreciate it, Michael B. Back to you, David.
All right. Thanks, Price. Yeah, excellent offer. So thank you to be here to talk to the Timing Research audience, and thank you for making this offer
Really
to them.
enjoyed it. Thank you,
So,
David.
right. Yeah. So everyone be sure to go to TimingResearch.com/BT, and that'll take you to that offer. Also, if you want to review the recording of this, it will be available on the main TimingResearch.com site as soon as I can get it posted. Also, if you search for Timing Research on YouTube, Substack, or your favorite podcast app, you can find the recording there as well as soon as I can post it. So, all right. Thanks, Bryce.
Thanks again, David.
And thank you for everyone for being here.
Take care, everybody.
Thanks.